If you had $1,000 to invest today, what would you actually do with it? Most beginners either overthink it or put everything into one risky stock. But investing is not about guessing, it's about structure. In this video, I'll show you a simple and realistic way to build a $1,000 investment portfolio designed for long-term growth. The biggest mistake beginners make is putting all their money into a single company. It feels exciting, it feels bold, but it dramatically increases risk. Even great companies can struggle. Even strong industries can decline. That's why smart investors focus on diversification. Diversification means spreading your money across different companies, sectors, and even different countries. Before we move forward, let's slow down for a second. Diversification is not about avoiding losses completely. It's about reducing the impact of any single mistake. When one company fails, your entire financial future should not fail with it. That's why serious investors think in systems, not guesses. Systems create predictability. Predictability reduces emotional decisions, and emotional decisions are the biggest threat to beginners. Let's build a simple example. Imagine you have $1,000. Instead of picking one stock, you divide that money into structured categories. For example, 60% into a broad market index fund, 20% into international markets, 10% into bonds or stable assets, and 10% into higher growth opportunities. This approach balances growth and stability. It reduces risk without eliminating potential returns. At this point, some people might say, why not just invest the entire $1,000 into the highest growth option? And on the surface, that sounds logical. If growth assets have higher potential returns, why not maximize exposure? The answer is risk tolerance. When you invest 100% into high growth assets, you are also accepting 100% of the volatility. That means sharper drops, bigger emotional swings, and a higher probability of making reactive decisions. Let's imagine your $1,000 drops to $700 in a market correction. If your entire portfolio is aggressive, that drop feels heavy. It feels personal. It feels like failure. But if your portfolio is structured, if only a portion is aggressive, the drop becomes manageable. This is the difference between investing and gambling. Investing respects uncertainty. Gambling ignores it. Another important factor beginners underestimate is personal psychology. You are not just building a portfolio, you are building a system you can stick with. A perfect strategy that you abandon during volatility is worse than a simple strategy you follow for decades. Simplicity increases consistency. Consistency builds wealth. Now let's talk about scale. $1,000 is just the starting point. The real power appears when you add to it. If you invest $1,000 this year and another $1,000 next year and continue doing that consistently, your portfolio begins to compound. Compounding is not dramatic in the beginning. It feels slow. In the first few years, growth is incremental. But as the base becomes larger, the growth accelerates. This is why time matters more than timing. If you try to wait for the perfect entry, you may never start. But if you commit to a structured allocation and repeat it consistently, you allow time to work for you. The goal is not perfection. The goal is participation. Participation in economic growth, participation in innovation, participation in long-term expansion, and participation requires patience because markets reward discipline, not impulse. Now imagine repeating this structure every year. Instead of $1,000 once, you invest $1,000 consistently. Over 5 years, that becomes 5,000. Over 10 years, 10,000. And as your income grows, those numbers increase. What starts as a small portfolio becomes a serious financial asset. The key is not the amount. The key is repetition. A broad market index fund gives you exposure to hundreds of companies at once. Instead of trying to predict which single company will win, you invest in the overall economy. Historically, broad markets have trended upward over long periods of time. Not every year, not every month, but over decades, economic growth and innovation have driven markets forward. There will be recessions, there will be market crashes, there will be uncertainty. But historically, markets have recovered, and investors who stayed disciplined were rewarded. The mistake is not experiencing volatility. The mistake is reacting emotionally to it. Many beginners forget about international exposure. The world economy is larger than one country. By allocating a portion of your portfolio to international markets, you reduce reliance on a single region. Different economies grow at different times. Global diversification adds another layer of protection. Now let's talk about stability. Including a small portion of bonds or stable assets can reduce overall portfolio volatility. This doesn't eliminate risk, but it smooths out the ride. And when investing long-term, emotional stability is just as important as financial growth. When your portfolio drops, you should expect it, not panic, not surprise. Expect it, because volatility is normal. Preparation removes fear, and fear is what causes bad decisions. Finally, allocating a small portion to higher growth investments adds potential upside. This could include technology-focused funds or innovative industries. But notice something important. It's only a small percentage. Smart investing is about balance, not extremes. Over time, different parts of your portfolio will grow at different speeds. That means your original percentages may shift. Rebalancing simply means adjusting your allocations back to your target structure. This keeps your risk level consistent and prevents overexposure to one area. A $1,000 portfolio will not make you rich overnight. But investing is not about overnight success. It's about building habits. It's about consistency. Over years and decades, disciplined investing compounds into something powerful. Most people underestimate what consistency can do. They overestimate what they can achieve in 1 year and underestimate what they can achieve in 10. The difference between average investors and wealthy investors is not intelligence, it's patience. If you commit to structure, avoid unnecessary risk, and continue investing consistently, the results become inevitable over time. You don't need thousands of dollars to start. You need structure, you need patience, and you need a long-term mindset. Start small, stay consistent, think long-term. This is the long game.